What's up, everybody? Today we are going to be doing a dive into Elevance Health. They are one of the largest healthcare companies in the US, the second largest health insurance company behind UNH, and I think they're offering an absolutely incredible opportunity today. I just added this company to my portfolio last week. Yes, there are real risks and concerns here, tightening on Medicare Advantage rates, cuts to Medicaid, but if it weren't for these concerns, this opportunity probably wouldn't exist today. Less than a year ago, this stock was in the 500s. Now it's under 300. I'm going to explain why I think Elevance is going to be a winner, why I think the risk reward looks excellent from here. I'm looking at a triple on the stock in my base case over the next 5 years. If you get value out of this video, subscribe to the channel. And before we dive in, I want to give a huge thanks to everyone who's found my channel for my last video looking at the healthcare space in general. If you haven't seen that video, I'm going to put the link in the description. I think it's a great overview of why I think a lot of these big players in health insurance are deep value today. And I want to respond to two types of comments I got on that last video before we dive specifically into Elevance. The first type of comment, I got a few variations of this, but it was essentially, if medical costs are rising, why would we want to invest in health insurance companies? Won't that just squeeze the bottom line? Why are they going to make money here? And I think my response would be, just taking a step back, there's two things that drive profit for a company. There's the revenue, there's that top line, how much money are you bringing in? And then there's the margin. After paying out all your costs, how much of that do you get to keep as profit? Now, I made the case in the last video for why the revenue for all of these companies, Elevance, UNH, Centene, all of them, it's going to go up over the next 5 to 10 years. The population is aging, the demand for healthcare is only increasing, revenue is going up. The real question is about margins. This year, you have pretty much every company in this space reporting margins getting squeezed, costs were higher than they thought, and I don't think we're going to see this turn around this year, not from Elevance, not from UNH, but the thing is, a year is a short amount of time in the context of an investment. These companies are going to reprice their plans. UNH, Elevance, they're not going anywhere. We'll dive into Elevance's earnings, what management said on their call, but I strongly believe that their margins are going to normalize. And if you agree with that point of view, if you agree with that mindset, there's going to be some bad quarters here. But the long-term role of Elevance's business has not changed. We're going to look back at this company 5-10 years from now, and the revenue is going to be higher, the earnings are going to be higher, the free cash flow, it's going to be higher. And I think we're going to say, 2025, that was a real opportunity in this entire space. And the second comment I got a few different versions of was, these companies might be value, but I just don't want to invest in health insurance companies. I just don't like them. And my response to that is, whether it's health insurance or tobacco or whatever the company is, if you're not comfortable investing in the company, don't do it. I'm not here to convince anyone to invest in this space. Some people aren't comfortable investing in defense companies or alcohol companies, or, maybe you don't like investing in Amazon because you feel like they killed mom and pop shops. Whatever it is, if you don't like a business, you don't have to invest in it. In fact, I think you shouldn't. I think you should say this investment is not for me. A lot of investing is managing emotions, and if you're invested in a company that you inherently just don't like, then maybe when the stock goes up 10 to 20%, you try to get out as quickly as possible and you miss a huge run up. Or if the stock drops a little bit, you just want to sell, saying, why did I invest in that horrible company? Either way, if you don't like a business, just say it's a pass. There's thousands of stocks in the market. There will be other opportunities. A stock might be a buy for me, but not a buy for you, and vice versa. That's totally okay. Now, with that out of the way, let's jump into Elevance. I pulled in a bunch of fundamental data on this company into my sheet. We see that their revenue has basically just been going up and to the right. They had a period of low to mid-single digit growth on the top line after the financial crisis till, about 2018. And then we see the company really picked up. You might ask the question, did anything change in 2018? Is Elevance's business model a little bit different now than it used to be? And the answer is yes. First of all, Elevance, they used to be known as Anthem. You might recognize them under the brand Blue Cross Blue Shield. Their business used to be almost exclusively just selling health insurance. We see that Elevance has a huge presence in the commercial market segment here. A lot of these are employer-sponsored plans. These tend to be higher margin plans. There are tons of companies that use Blue Cross Blue Shield. Medicaid has become a fairly big part of Elevance's business, not as big percentage-wise as it is for Centene or Molina, but keep in mind, Elevance is a larger company. So this is 20% of a larger pie. Elevance has a huge share in the Medicaid market. They've lost some membership recently, and we'll talk about that. They're also involved in Medicare. United and Humana are bigger players than Elevance in Medicare Advantage, but this is still an important part of the business for them. But as far as what changed around 2018, Elevance, they don't just sell health insurance now. Health insurance, what they call the health benefits side of their business, That's still the majority of this company, but they're also growing in health services. So they've gone for a whole kind of vertical integration of the healthcare chain here. Carelon, it's not just coordinating care for patients, they also have their Carelon RX segment here. That's their pharmacy benefits manager. You might have heard of those referred to as PBMs, and they handle prescription drug benefits. They negotiate with pharmacies on prices. Before building out Carelon, they would be working much more with various other subsidiaries here. But now a lot more of this is under one umbrella, from pharmacy to care delivery, and they have a business model now that is much more like UNH. If you don't know UNH, they don't just sell insurance either. They also have Optum. CVS, they don't just sell insurance under Aetna, they also have their Caremark PBM. These are the big players. A lot of these smaller niche insurance companies, they don't have this big health service arm. They don't have a big PBM. And integrating this whole thing into one healthcare chain, it's allowed companies like UNH and Elevance to increase the margins a bit. Now, don't get me wrong, the margins on health insurance are very, very slim. We see operating margins for this company typically been about 6 to 7%. Of course, recently we've seen that fall under 5%. I think that's why there's an opportunity here and the stock has fallen so much. But many smaller health insurance companies, they're struggling to reach 5% margins. And Elevance really started growing this Carelon segment in 2018. You can just see it on the graph that this has been a huge success for them. And the current CEO of Elevance, Gail Boudreau, she came in 2017, so she's been there about 8 years. She's overseen the growth of Carelon, and I think she's done a pretty good job managing the business. Now, interestingly, just a couple weeks ago, she bought over 8,000 shares worth of Elevance stock on the open market. So a little bit more than $2.4 million of her own money that she was putting behind the stock. We see the past few years, insiders selling. This is pretty normal. Executives get a lot of options, a lot of shares as part of their compensation package. And so typically what you'll see is they're exercising their options, they're selling their shares. That's not necessarily a negative for the stock. But when you see an insider make a big purchase on the open market, here's Gail Boudreau here buying about 8,000 shares worth. That's definitely a green flag, definitely something I like to see. Now, this was only about a 6% increase in her position, so it's not like she's going all in. Insider purchases or sells should never be the basis for your decision to invest in a company, but it's definitely nice to see that management is, in for the ride with us common shareholders. Now let's dive into their second quarter earnings report. The market did not like this. It dropped about 12% on the day of this report, down now about 16% from the day before it came out. Now, the top line looked great. Operating revenue growing by 14%. That's excellent. The problem is their costs grew a lot. Medical loss ratio, this is representing what percent of the premiums that people pay, what percent of that actually goes to paying for healthcare. 89%, that's very high. And you might see, it's only up 2.6%. That doesn't seem like that much. But in a business of razor thin margins, this can completely crush the bottom line. They also cut their guidance, which the market never likes. Now they're saying adjusted earnings per share of about $30 for the year. Keep in mind, the stock today is trading for under 300, so less than 10 times that number. They reduced their guidance on operating cash flow to $6 billion. This company is still just making a massive amount of money. $6 billion operating cash flow on a company with a market cap around $65 billion. We'll get into management's comments in a second, but they basically said profitability is going up from here. We're going to increase our margins. Earnings are going to grow 12%. I mean, if you believe a fraction of that, this company is just dirt cheap. And here we see in the summary of their results, top line looks amazing. Bottom line, it's down. And medical loss ratio going up 260 basis points, 2.6%. And we see that in the health benefits segment, adjusted operating margin down 200 basis points. That small increase in costs has a big effect down here. Now we see membership is down just slightly, and I want to talk about that for a second. And this is a bit of a COVID effect. From 2020 to 2023, the states were not disenrolling people from Medicaid due to the pandemic. And then in end of 2023 and throughout 2024, people were going through redeterminations, basically redetermining, are you eligible for Medicaid? So because of that, Medicaid enrollment was artificially high for Elevance, and now it's dropped and normalized. This period of redeterminations is essentially over. I do not expect Medicaid membership to continue dropping. And they say here the drop in Medicaid was partially offset by higher retention rates in Medicare Advantage and increases in their commercial segment. And while the profitability for this quarter doesn't look great, I think this problem is going to be temporary. Management mentioned multiple times on the call that profitability is going to improve, multi-year plan to stabilize margins and build sustainable earnings power. In ACA, we've already repriced products for rising cost intensity. In Medicaid, we're proactively engaged with state partners on the upcoming rate cycle, we expect a meaningful catch-up. In Medicare Advantage, we bid with a focus on margin normalization. So they're aware of the problem, and a lot of the things they're doing to fix it, we're not going to see the benefits of that on the bottom line until probably at least 2026. I don't think the next couple quarters are going to be great, but management is saying they think this year is going to be the bottom. In regards to cutting the guidance, they said, "We are choosing to act now, not later, to ensure our outlook reflects prevailing conditions and to give investors clear visibility." So they're not assuming some recovery for the rest of the year. They're assuming that the pressure they face now will continue for the next couple quarters. But throughout this call, they talk about rebuilding long-term margins. Now, it has to be said, the health services side of this business, so the Carelon side, they reported a pretty decent quarter. Top line growing amazingly well. The bottom line on this segment also up. And this was probably the one bright spot in the short term, but in the long term, I think there's a lot to like here. Management is targeting at least 12% average annual growth in adjusted earnings per share. And this is a management team that prior to this year has done a pretty good job of hitting their goals. They're saying the top line is going to grow high single digits, which is pretty much what we've seen historically from this company. The health benefits side of that is going to grow a little bit slower, but the Carelon side and their PBM, Carelon RX, is going to grow faster and offset that a bit and make up a bigger percentage of this company. They're saying adjusted operating margin is going to be about 6.5 to 7%, and that's also, pretty much what we've seen from this company in the past as well. The story that management is telling us is, yes, this is a bad quarter. Yes, this likely will be a bad year. But as far as the long run outlook for this company, nothing has really fundamentally changed. And while we wait, management has been returning capital to shareholders both in the form of buybacks and in dividends. Elevance keeps buying back stock every year, about a few percent a year right now. And on the earnings call, the CFO was asked, what are your thoughts about capital allocation for this year? And he said, "In my opinion, with the stock trading well below what we see as its intrinsic value, I really want to make sure that we retain full flexibility to be more opportunistic. So we anticipate lower levels of M&A activity this year with a greater emphasis, as I mentioned a minute ago, on opportunistic share buybacks." I love to hear this from management. This is a big green flag for me. A lot of times when management does buybacks, they don't necessarily do them at the most opportune times. They do it when the stocks are at highs and times are really good. But, when you're buying back stock, it really matters what price you're paying for shares. So this is great to see. 30% of capital going to share repurchases. Now let's go back to our sheet and see what we could expect for a return on our investment if we buy Elevance stock today. I'm giving them 7% revenue growth on the top line, which I think it's rather conservative. Management is guiding for high single digits, and historically it's been, closer to 10. The top line grew significantly faster than this quarter. Again, the top line hasn't been the concern, it's been margins. I'm estimating they get back to 6% operating margins, which is lower than the 6.5 to 7% that management is guiding for. I think only about 2% of revenue is going to be returned to us shareholders in the form of dividends and buybacks. And in 5 years, I'm giving them just a 12 times multiple. This is giving them credit for a bit of multiple expansion, but I think it's completely reasonable for a market leader that's growing on the top line by 7%. It's not really some crazy valuation. And if our assumptions in this scenario come true, you're looking at a 26% annualized return on Elevance stock over 5 years. That is more than a triple on your money. Even in my bear case, where I'm giving them just a 4% growth on the top line, which would be a scenario where Medicaid cuts reduce eligibility and Medicare rates probably remain tight, I'm giving them just a 4.5% operating margin. So the margin that they have now, that continues for 5 years. They have no recovery, and I'm only giving them a 9 times multiple. In that scenario, you're still making a 5% annualized return, which for a pessimistic bear case, this is excellent. If I made a 5% return every time I invested in a stock and I was completely wrong about it, I would take that risk every day of the week. And in our bull case, in the optimistic scenario, I'm assuming revenue growth of 9% on the top line. I think that's very achievable. I'm assuming operating margins gets to the 6.5% that management is guiding for, and I'm giving them a 15 times multiple, which yes, is a premium to where they're trading for now. It's towards the upper end of where they've been over the past 10 years, but I don't think it's unreasonable. And if this scenario comes true, you're looking at a 38% annualized return. This is basically a 5x on your money over 5 years. In summary, when I look at this, when I'm modeling out Elevance, I just think it's probably presenting one of the best risk rewards of any large company in the market today. I like a lot of stocks in the sector. I don't own just one. We're also going to look at Centene. We're going to look at UNH. We're going to look at Oscar. But I think Elevance might be my favorite out of this group. And with that, I think we're going to leave this video here. As always, I'm not telling any of you to buy or sell anything. I'm just giving you my opinion and telling you what I'm doing with my money. If you got value out of the video, subscribe to the channel. The next healthcare companies we're going to look at are going to be Centene and UNH. If you agree or disagree with anything I said here, leave a comment down below. And I hope to see you all in another video.